You've probably seen the headlines about BYD, the auto giant, and maybe you've even heard these whispers comparing it to Evergrande, the property developer who's collapsed. Well, it sent shockwaves everywhere. The idea that a top EV maker could face the same fate, and it sounds pretty dramatic, doesn't it? So today we're doing a deep dive into exactly that comparison. We're going to look at why the market's even having this conversation and, maybe more importantly, what the really crucial differences are based on this stack of sources we've got.
Yeah, we've pulled together official company statements, market analysis reports, news coverage, and even a look back at the details of the Evergrande crisis itself.
Right, and our goal here is really to help you cut through the noise. You know how these stories get talked about? We want to understand the basis for the comparison first, but then really dig into what the data, the sources, and the companies themselves say about how BYD's situation actually stacks up against Evergrande's, let's say, well-documented struggles. Let's find the key insights here.
Okay, let's unpack this. Starting right with the official word from BYD itself. What did they say? Yes, the first thing that jumps out from the sources is that BYD has tackled this head on. They've explicitly stated they are not going to be another Evergrande Group. No. They firmly reject the suggestion they'll repeat that kind of failure, which, tells you it's a significant enough comparison floating around that they felt the need to address it publicly.
Okay, but that just begs the question, why? Why is the market even making that connection? What are the sort of surface similarities sparking this?
It's fascinating, actually. The comparison seems to largely stem from looking at BYD's, high debt levels and its incredibly fast expansion. The sources mention figures like total debt of 594.4 billion yuan in Q1 2025. And an asset liability ratio of 71%.
71%, okay.
Yeah, and a ratio like that, it basically tells you how much of a company's assets are financed by debt. 71% is objectively on the higher side. So figures like that can definitely raise eyebrows, especially if you just look at them superficially, next to a company that collapsed under debt.
Right, that big number immediately makes people cautious, especially after Evergrande. And you mentioned context. The sources also bring up the intense price war happening in China's EV sector, right?
That's absolutely a critical piece of this. The sources point to industry voices like the chairman of Great Wall Motor warning that this fierce price competition puts huge pressure on profits for everyone. And that pressure, if it keeps up, could potentially lead to liquidity problems for some companies. And that's where some draw the parallel to Evergrande. You see the pattern: aggressive growth, big liabilities, and then potential pressure from the market environment. That combination fueled some speculation.
Okay, so headline debt numbers, rapid growth, and the price war pressure, those seem to be the main triggers for the comparison. But this is where it gets really interesting, and where the sources seem to draw a very sharp line. While both have high debt figures, the nature of that debt, the structure, it seems fundamentally different.
This is the crucial question, isn't it? What kind of debt are we actually talking about? Because it's not all the same. For Evergrande, the sources detail this heavy reliance on, traditional high-interest loans. But critically, it was worsened by using these really risky wealth management products, WMPs, and complex supply chain financing. They used these basically to plug funding gaps when other money dried up.
WMPs?
Yeah.
Can you quickly unpack why those were so risky, according to the sources?
Yeah, the sources described them almost like shadow banking. Evergrande sold them widely, promised higher returns, and apparently even pressured their own staff to buy them. They were described flat out as too risky for retail investors. Essentially, they were short-term borrowing used for long-term projects, a huge mismatch. This structure meant they constantly needed new money just to pay back the old WMPs and loans. When property sales slowed down, that whole cycle just collapsed. It created crushing, unsustainable pressure.
A house of cards, basically, built on risky, short-term money for long-term needs. So how does BYD's debt structure compare, based on what we're seeing in these sources?
It's a stark contrast, really. According to the sources, BYD's traditional interest-bearing debt, the kind you pay regular interest on, like a bank loan, makes up only a small fraction, around 4.9% of their total liabilities.
Only 4.9%. That's tiny compared to the overall number.
Exactly. The vast majority of BYD's liabilities, the reports say, consists of interest-free debts.
Interest-free. Okay, what does that actually mean in practice? What kind of debt is that?
Primarily, the sources say it's things like accounts payable money owed to suppliers for parts they've already received, and advance payments from customers for cars they've ordered but haven't taken delivery of yet.
Okay. So it's more like the normal ebb and flow of money in a manufacturing business.
Precisely. These aren't high-cost loans needing constant refinancing like Evergrande's WMPs. They're operational balances. It's the working capital dynamic. And critically, this structure is backed by strong operational cash flow from actually selling lots of cars and their market leadership. It's debt arising from doing business, not from risky financial engineering. That makes a huge difference in terms of immediate financial strain.
Okay, so the type of debt is maybe the biggest difference. It's not just the number, but who you owe, the terms, and whether it's tied to operations or financial risk. What about the businesses themselves? Cars and real estate seem worlds apart.
Absolutely. And that connects directly to why Evergrande failed. Their problems were rooted in the real estate sector, specifically a collapsing market in China. Plus, they were hit by regulations like the 3 red lines rule, designed specifically to curb developer debt.
Right, you mentioned those rules designed to limit how much developers could borrow.
Exactly. The sources explain they set limits on debt relative to assets, equity, and cash. Evergrande blew past all 3, cutting off their access to new borrowing just when they needed it most. They were stuck. And on top of that, Evergrande went on this highly leveraged diversification spree theme parks, even a failed attempt at EVs draining resources from their failing core business. And their main assets, buildings. You can't easily sell those in a downturn.
Fixed assets stuck in a bad market.
And BYD, completely different picture. BYD is primarily an NEV new energy vehicle maker. They're in a market with huge government support, growing domestic share for Chinese brands. Sources say over 60% now, and massive EV adoption, over 52% penetration.
And they can sell overseas.
That's a key point one source makes. Unlike apartment buildings, you can ship cars. China's the world's biggest auto exporter, and BYD is having real success expanding internationally. There's asset mobility. Plus, BYD's management, according to sources, emphasizes focus on the core auto and battery tech. They're pouring money into R&D 54.2 billion yuan in 2024. Contrast that with Evergrande's desperate diversification.
So different debt types, different industries, different assets, different regulations. What about their recent financial health, the performance numbers leading up to this comparison?
Again, a dramatic divergence shown in the sources. Evergrande, leading up to its collapse, was in a clear, undeniable liquidity crisis. Missed payments, failed asset sales, credit downgrades piling up, and ultimately, liquidation ordered by a court in January 2024. Plus, remember those huge revenue overstatements reported in 2019 and 2020? Big fines followed, trust evaporated.
Total mess. And BYD in 2024.
The sources paint a picture of record performance. We're talking 777.1 billion yuan revenue, 40.3 billion yuan net profit, and crucially, substantial cash reserves, 154.9 billion yuan.
Very different from struggling to pay bills.
Absolutely.
Wow.
And BYD's own head of branding is quoted saying their debt-to-asset ratio, even at 71%, and their supplier payment cycles are actually comparable, maybe even better than other big Chinese automakers like Geely and SAI. There's also this broader claim in the analysis we looked at suggesting mainstream Chinese automakers, BYD included, are generally in better financial shape right now than their foreign competitors operating in China. So profitable, cash-rich, operational liabilities, not a liquidity crisis.
Okay, so putting it all together, while that initial high debt number for BYD might grab headlines and spark the Evergrande comparison, a deeper look into these sources reveals really significant differences. We're talking the type of debt, the fundamental business, the market environment, the regulations, and crucially, their recent financial performance and health.
That's right. BYD's leadership, as we said, strongly pushes back on the comparison. Some reports say they see it as potentially malicious. They point to their operational strength, profits, cash, market leadership in a growing sector. Directly contrasting it with Evergrande's specific real estate crisis, its incredibly risky debt structure, and its ultimate financial failure.
But despite all these clear differences the sources lay out, are there still lingering risks or similarities highlighted that we should be aware of for BYD? Things that could still pose challenges?
Yes, the sources don't completely dismiss all concerns. They do mention some potential challenges. Despite the denials, some critics still point to things like a possible reliance on extended supplier credit, basically maybe taking a bit longer to pay suppliers. And that intense EV price war we talked about, that pressure on profitability is real and ongoing.
Right. Even if they're profitable overall, the margins might be getting squeezed.
Exactly. One analysis mentioned that while overall auto profits improved recently for both US and Chinese firms, the Chinese companies actually saw the lowest profit before tax growth in 2023. That suggests the price war is biting, even for leaders like BYD. So factors like supplier credit and that profit pressure, they could become bigger issues if the EV market itself cooled down significantly.
So what does this all mean for you listening? Our deep dive into these sources really shows that while a quick glance at debt numbers might make you think Evergrande, digging deeper reveals crucial differences. Differences in the kind of debt, the business itself, the market, the financial health. It's not really an apples-to-apples comparison when you look closely.
Yeah, the sources strongly suggest BYD's liabilities are mostly operational, backed by a profitable, growing business in a sector that still has a lot of support. That's fundamentally different from Evergrande's situation, relying on risky, high-cost debt to prop up a failing business in a collapsing market.
But, as the sources also note, things like the intense competition and how they manage supplier relationships, those are definitely points to keep an eye on in this fast-moving EV world.
Which brings us to the final question for you. Considering everything we've unpacked from these sources, the clear differences, but also those potential pressures, where do you land? Do you think BYD, despite the evidence, could still somehow stumble into an Evergrande-like situation? Or do you believe it's on a fundamentally different track, set for more sustainable growth in the global auto industry?
We would genuinely love to hear your thoughts on this. Please leave your comments.